can you hand him the mouse? I need it anyway. So this worked out fine.
Yeah, get the deck back.
Right. Hi, everybody. How are you? It's good to be here. Here today talking about some great news about TAB. You have heard by now that TJ sold TAB, and that TAB Computer Systems Inc. is now a 100% ESOP owned, employee owned company, which is great news. So today we're going to talk a little bit about what that means and some details and some specifics about it and how it affects you. Well, let's start with what is an ESOP. An ESOP stands for Employee Stock Ownership Plan. I point this out because many times people think, they explain it to their significant other or somebody else, hey, I have stock options at work. Well, that's not what this is. An Employee Stock Ownership Plan, or ESOP, means something specific in the tax code. It's a true blue defined contribution retirement plan covered by the Department of Labor, the IRS. It's a retirement plan like a 401k, a profit sharing plan, a pension plan. You have same discrimination rules, contribution rules, and we got to follow those things. It's to maximize benefits, which we do. Oops. Excuse me. Well, there's about 6,000 ESOPs in the United States. It holds over $1 trillion in assets, which is a lot for 6,000 ESOPs. In big companies, small companies, so you'll see it across the board, different industries and sizes. Well, the ESOP was an immediate buyer for TJ. We didn't have to go shop the market and have maybe competitors come and try to learn everything about the company and then not buy the company and having that information out there. It was an internal sale without those external third-party interest. And as everybody wanted, we wanted a smooth transition to the management team, which is what happened. And it is the most tax advantage way of transitioning a business from an owner to somebody else or something else, such as the ESOP. We'll explain a little bit more about that in detail. Well, why was an ESOP considered? Well, TJ and Tony and the rest of the management, they really valued, since day one, we were told how valuable the employees are, what a close-knit group, and that the contributions made all these years built the company to where it is today. And with TJ having different options, we really examined what the long-term effects of those different options are. And in ESOP, one of the goals was to reward long-term employees, ensure that TAB continues way long into the future, that an outside buyer wouldn't do some negative things we were concerned about. And ESOP is a way to ultimately reward long-term and future employees with maximum retirement benefits. Now, I'll take a step back now and say, TJ had many options, right? There's many ways to sell a business or take money out of a business. And TJ was concerned about, leaving the company in a good financial situation, taking care of the employees, not changing the culture, and he sacrificed some things. I mean, he could have made more money selling to some outside buyers. He could have gotten his cash all up front, chose not to for the well-being of the long-term outlook of the company. And so he sacrificed some to ensure the legacy and the employees had a secure retirement and that there wouldn't be a major change in culture or a change in the way we do things. And that was very important to Tony, TJ, and all the management that were involved in this. So hats off to everybody making that decision, because those things that we're concerned about are legitimate concerns. So what do we do? Well, management formed an ESOP trust, an ESOP plan and trust, which means they just created another retirement plan. As I mentioned, ESOP's like a 401k or any other kind of retirement plan. We created another one. And then TJ sold 100% of his company to the ESOP. So now the ESOP trust owns the company completely. And by definition and by federal law, the stock that the ESOP now holds must be held exclusively for and only for the benefit of the associates of TAB Computer Systems. Literally, the employees of TAB now own 100% of the company, own 100% of TAB Computer Systems. And then when you retire or exit the company in any way, you take your cash, your vested portion in cash with you. So the process was we hired an independent trustee. It's somebody that represents to the Department of Labor and represents solely the employees of the company. They hire their own valuation firm, their own lawyer, and they come up with a value they're willing to pay, and then negotiated with TJ for a fair price. And this person represents to the Department of Labor, along with opinion letters and with independent valuations on their side, that the ESOP didn't pay too much for the stock, that the employees didn't pay too much for the stock. And they attest to the Department of Labor should they ever ask. Because to prevent, sometimes in the past, you'd have an owner hire their brother-in-law and create a value and take out more than the company was worth. That absolutely did not happen here with that independent trustee and all the safeguards that are put in place under the standard operating procedures of the Department of Labor. So what does this mean? As I mentioned, 100% of Tab Computer Systems stock is owned by the ESOP Trust for all of you, for all the employees of the plan. Stock is held in the ESOP Trust. The trustee and the ESOP committee and an ESOP council will discuss, represent you, the employees. Now, the trustee is kind of the top person representing you. They're professional ESOP trustees. It's what they do. They represent the Department of Labor that things are going well. The plan's not discriminating. They're following the rules set forth and providing the benefits the plan dictates. The key part for you, the employees, is the participant or employee. Whatever stock is in your name, whatever the vested portion of the stock in your name is redeemed for cash at retirement, death, disability, termination, that means quit or fired, and something called diversification. That means when you've been in the plan for 10 years and you have attained the age 55, and then you have the ability to diversify your holdings. Take some of your assets you have in tab stock and diversify, and taking some, reallocating to other type of more diversified investments, which is kind of a smart investment kind of rule of thumb anyway. And then when any of those events happen, then the participants, you can take that money, and you haven't paid tax all along the way. You have not a nickel of tax, just we're tracking the stock value on your behalf. When you retire, you get cash. And if you take that cash, you can roll it over into a personal IRA or individual retirement account, which also continues to defer tax. You don't pay tax. But when you do pay tax is when you decide to use your IRA, then when you take it out to use it for whatever you want to use it for, you're subject to federal or state income tax in your state. Power of employee ownership is pretty dramatic. In general, ESOP companies are 25% more likely to stay in business. The flip side of that coin, 4 times less likely to be laid off. And that was true during the 2008 recession. And it's proving true during COVID. ESOP companies, when employees have a stake, they tend to stick around, rally around more. And to be frank with you, there's a lot of tax advantages to ESOPs, which helps companies stay in business as well. In fact, this third bullet point is big. It's not a guarantee, it's not a promise, but industry standard, industry average, since they started keeping stats on this kind of thing, an employee at an ESOP company averages 2.5 times the retirement plan balance than the same employee at a non-ESOP company that only has a 401k. The average is 2.5 times retirement benefit over the same employee at a company that only has a 401k. Pretty dramatic. And that's why the government likes ESOPs. Both parties really like ESOPs for different reasons. One party likes it because employees are getting shares where they work. The people that are doing a lot of the hard work are getting shares in the company where they work. That's a great thing. The other party tends to like that when employees have independent wealth, those are less people that are going to be relying on the government safety nets. And so they really like ESOPs, even despite all these really big tax advantages, which we're going to talk about. ESOP participants average higher wages. Average wages go up, as I said, higher job growth rate, increased sales, profitability. All of these things increase when employees have a stake in the company where they work. and it's across the board statistically. Now, what do you pay for this? You might be thinking, what's this going to cost me? Are you going to payroll deduction? Are we going to eliminate my other benefits? No, the answer is the cost to you is zero, nothing, not a zip. It's not going to cost anything to the employees. You're not giving up any pay or any benefit whatsoever. 401k stays in place, the match stays in place, all other compensation remains the same. It's just paid for entirely by TAB computer systems. Now, part of the reason TAB can afford to do this is some of the tax benefits that I referenced earlier. The ESOP trust, like any other type of retirement plan, is tax-free. It's tax exempt. So whereas before, when an individual owned or owns any company, either the company pays tax or the owner pays tax. One way or the other, somebody's paying federal tax. In an ESOP, because the ESOP is a qualified retirement plan, just like a 401k, it doesn't pay income tax on the profits federally. And so therefore, that means the profits of TAB from this point forward are not taxed again by the federal government. Literally, let me say that again. The profits are not taxed. This is a tax-exempt company now, just kind of like a nonprofit. There's no taxes being paid, which is federal taxes are being paid. Depending on the state, like Connecticut, there may be a state tax due, but federally, no income tax due on the profits. That increases the cash flow of the company dramatically.
As a matter of fact, one of the things in the state of Connecticut was there is something on the books called a pass-through entity tax, which is what this plan is in the eyes of Connecticut law. It's 7%, which is another fancy way of saying tax. I'm not sure why they had to give it that additional label, but having even though having that 7% responsibility to pay the state of Connecticut, there's nothing to pay the federal government with the structure. So that will be very helpful for TAB in the long run, and by extension, all of the employees.
Right. And that tax savings goes right to the bottom line of the company. And since it doesn't have to leave the company to pay tax to the federal government, that portion stays at the company. And that's the money we use to pay off the debt we incurred to buy all of TJ's stock. And so what money used to go to pay taxes is now paying off the bank loan TAB took and the personal loans that TJ took in getting paid over time. Because one of the things I mentioned earlier was TJ could have had better terms in selling the business. Could have got all his money up front, chose not to do that. Could have got potentially higher price, chose not to do that for the benefits, for the reasons we talked about. This tax savings is going to be used to pay off the bank and to pay off TJ's payments over time. And then when that's done, it goes right to the bottom line of the company and to be used to grow. That's some of the statistics I talked about before. That's how the company really grows. When taxes aren't paid and all the debts already repaid, that's just extra money right to the bottom line of the company to pay more, hire more, grow, expand, do all kinds of good things that grows the value of the company. And unlike before, who benefits from the growth of the company now? You do. The employees do. The beneficial owners and the ESOP benefit from that directly. Oops, excuse me. The plan was effective January 1st, 2021, not 22, 21. So the plan's been in force for over a year now, the way we did this. So if you're age 21 and employed by TAB on January 1st of 2021, you automatically became a participant in the plan. So you've been in the plan over a year. Anybody employed after January 1st, 2021 must meet basic eligibility requirements we'll discuss shortly. As I mentioned, the 401k, what happens? Nothing. And I scream from the mountaintops, defer, defer, defer. 401k is a phenomenal way to put money away for your own retirement. And in addition to, TAB is not getting rid of the match, which is an incredibly generous match. I highly encourage you to defer, take advantage of that, as well as the ESOP.
What I always say to people, and I've mentioned it before, is just that slogan about the 401k is, it's never too early and it's never too late. That's just always something to remember if you're, wherever you are, if you're not in it and thinking about getting into it, or if you're in it and thinking about increasing how much you contribute, never too early, never too late. It's always the thing to remember.
Agreed. What can we expect in the future? What's going to change? Well, first of all, management structure remains in place. just to manage expectations. We're not going to get together and have group votes on major decisions. Now, there will be input, a lot of input, but we still do have a management structure. I would say the management stays in place, but there, as you know, been a change. TJ is no longer president, and Tony is the new president. So congratulations. So we look forward to great things. Generally, there's reduced employee turnover. People don't leave in ESOPs, or at least as much, because shares of the company, although the ESOP bought all the shares up front, they will be handed out over the next 25 years. So for the next 25 years, shares are going to be handed out to employees over time. So every year you stay here, every year you get more shares into your personal account. And then as the stock grows, your account balance grows. So that's why ESOPs retain employees, and they're so good for that kind of thing. And why, when you stick around a while, the account balances can really grow to the tune of the average 2.5 times an average employee that has a 401k only. So generally, company-wide focus on, how do you get profits, right? You increase revenue and you cut costs. Now, with that being said, I would be neglected. I would be, what's the word I'm looking for? I wouldn't be doing the right thing if I didn't say, be careful with this. Sometimes people try to cut costs to the point where it damages the reputation of the company. It doesn't look good, and you might actually lose business and lose revenue because of trying to save a penny. For example, in a different type of industry, I had a manufacturing client who was trying to save every penny they could to grow value. They were reusing cardboard boxes that had like FedEx stickers on them, and they're ripping them off and taping them back up and sending a really high quality computer screen to their clients. Well, the clients said, well, geez, if the outside, they went to an ESOP and the outside looks like this, what's the product like on the inside? And so they actually hurt their business. I'm not suggesting anything like that. What I am suggesting is, hey, in our normal day of business, is there some way or some idea that, hey, we're missing the boat on this? For every client that buys this, they could probably use this too as an add-on. Maybe we should offer that. Or, hey, we don't really do that well in this product line. Maybe we should shift focus on this and not do this. It might increase profitability. Just things like that, that might, that I don't know, that might increase performance and increase profitability. And as that happens, stock value goes up. And once again, that's enjoyed exclusively by the employees. You share all that. The ESOP, now this is a diagram that you're welcome to have, but I'm going to summarize this whole thing. Here's how the thing works. The ESOP, the retirement plan, borrowed money. The ESOP used that money to buy TJ stock. The company uses all the tax savings we generated to contribute to the ESOP every year, and the ESOP uses that money to pay off the debt. And then the employees cash out when you leave employment. That's really what this boils down to. And you can have this to study on your own if you'd like, and I'm happy to answer questions at the end. Now, the eligibility requirement I mentioned, if you were not an employee on January 1st of 2021, you have to meet these eligibility requirements. W-2 non-union employee, age 21 or older, 1 year of prior service, which is 12 months. And in that 12 months, 1,000 hours of service, which is about half time. So once you meet that criteria, you meet those criteria, whichever comes first, you enter the plan, whether it's January 1st or July 1st. So after you meet the criteria, the next, either January 1st or July 1st, you become part of the plan. But once again, if you're employed on January 1st, 2021, you do not have to meet these requirements. I think I mentioned that TAB will be making contributions to the ESOP over the next 25 years. And through some technical reasons, that means that for 25 years, shares are going to be put into individual employee retirement accounts and into your participant accounts, I should say, your ESOP account. So every year you're going to see additions to your ESOP account, and you're going to get a statement that'll show you the value of that. So, hey, the longer you stick around, the more you participate. So for the next 25 years, the ESOP will be putting ESOP shares into individual participant accounts, which is great news. So you might say, okay, fine. For every year, for 25 years, shares are going to be put into employee accounts. Well, what do I get out of that? What's my percentage of that? Well, it's just simple division. We're going to take any given employee's compensation divided by the total payroll, and that's how much they get that year. So, for example, if an employee makes 1% of payroll, they're going to get 1% of the ESOP shares that are being allocated that year. They get a raise. Next year, they make 1.2% of payroll. They get 1.2% of the stock being allocated next year, and so forth. It's just new math every single year. Now, to get an allocation, that's the formula we said, but to get an allocation, couple minimal things here. You got to be employed the last day of the year, December 31st, because that's the end of the plan year. You have to be employed that day to get an allocation for that year. And during that year, you had to have had 500 hours of service. Just as an example of what I said verbally, this is a hypothetical, has nothing to do with TAB. If one has an income of $60,000 and payroll is $10 million, that person would get 0.6% of allocations that year. Once again, they get a raise. Maybe they make 80,000 next year. They might get 0.8% of that year's allocation. It's just an annual calculation. Let's move on to vesting. You're probably familiar with what vesting is. That's the time when vesting is the period that goes along that says, well, of the benefits that were earmarked for you, it's when they permanently become yours and can't be taken away. And almost every qualified retirement plan has a vesting schedule, and we'll put it up on the next slide, but you have to go through that schedule, and then it's yours. No matter why you leave or how you leave, nothing can be subtracted from it. The good news is the vesting clock began January 1st, 2021, so over a year ago. And something else was very generous, TAB did. Most companies, when they do an ESOP, they say, hey, new plan, new vesting schedule. Everybody has to go through the 6-year cycle. TAB said, you know what? We've had some people that have been with us for a while. So for every 5 years of prior service, prior to January 1st, 2021, for every 5 years of prior service, 1 year of vesting is credited towards the schedule. So for 15 years of service, that's 3 years towards the 6-year vesting schedule already under your belt. Very generous thing to do. Here's the schedule. And this is the raw schedule, right? If you had to start from scratch, less than 2 years, 0, and then 2 to 3, 20, 40, 60, 80, 100 until you're 100% vested. But this doesn't account for prior service. And if you have prior service more than 5 years, you can jump the schedule somewhat. You can figure that out and when you're on there.
Just to give you all the comparison to the 401k, because the 401k rules, TAB's match is 100% vested for all of us. Once you start to contribute, you could have 100% vesting. We couldn't carry that schedule into this one because it's an entirely separate plan, different legal document. There's no, can't mirror the two. So that's how we found that middle ground. We said, okay, but what we can do is we can do that 1 year for every 5. So we're able to put something together. We just can't have the match schedule that the 401k has.
You will get an annual statement. Once a year, probably around May, June, you're getting a statement that says, well, it has your name on it, of course. It'll have the number of shares that were in your account from the previous year. It'll tell you how many additional shares you got that year. It will also add in forfeitures, which means if other people left the company and they weren't 100% vested, their shares go back into the pool and reallocated to all of you that stuck around. So you're picking up with their unvested portion in addition to your annual allocation. And then it'll also have the value of the shares and what percent vested you are. You get that every single year. Without getting too deep into valuation, I did talk about just briefly earlier that independent trustee, and I say independent, truly independent, they represent to the Department of Labor that it was a fair valuation, and they hired their own trustee, they hired their own valuation firm, and it was a fair value. And that's the reason I say this a couple times now is it's very clear that TJ got a fair price, but wasn't overpriced, and he didn't get more than a reasonable buyer. Now, you could get some other people that would have been interested in TAB would have paid more than a reasonable value because you're such a valuable company. But it was an arm's length transaction with a fair valuation, and TJ accepted. Now, this is important. I want to talk about the third bullet point here too. I want to manage expectations to some extent here. Since TJ and the bank need to be paid for the stock, we borrowed money. The company borrowed, and TJ borrowed 100% of the sale price. There's a lot of debt on the books of TAB right now because we bought 100% of TJ's stock. Just like a home, if you have a house, and my example I used today was if you have a house that you purchased for $300,000 and you borrowed $290,000, you put a $10,000 down payment, what's the equity value of the house? $10,000, right? Because you have debt against the value of that house. But as you pay off your debt, as you pay off the mortgage, if you will, your equity value goes up. So if you pay another $40,000 towards your mortgage, now your debt's only $250,000 out of the 300. Your equity value is $50,000. And eventually, when your mortgage is paid off, you own the house outright, and your equity is $300,000. That's assuming no growth. The good news is, like your home, which hopefully is appreciating organically underneath, right? Hopefully, it's growing at 2, 3, 4% a year. Same thing with TAB. And so, in effect, TAB has bought the employee as a house and are paying the mortgage. But the effect of that is early on, because of all the debt, the share price, the value in your ESOP is going to be fairly minimal because it's 100% debt against the books, not zero like the mortgages or close to that. It will be very low, but you will find that in the next couple years, as you start getting more shares, you'll notice the debt's being repaid fairly rapidly. And so the equity value itself is going to be bumping up from a low amount. It's going to be bumping probably pretty well. In addition to that, TAB is a tax-free company that's going to be growing organically pretty well. No guarantees, but that's typically what happens. So we have two things working here. We have debt being repaid fairly rapidly, and we have the underlying value of the company growing as well. So both things working in your favor. So when you see the initial stock price, that's just a natural function of debt. But as they get paid off, give it a couple years. Wait till you see what happens. This is an example. This slide is an example just of what a company without debt, the share price looks like. You have a company with no debt. Share price hypothetically has nothing to do with TAB. Might be $10 a share. And then as you look on the right column, the columns down further, you take that debt on $1 million company to $800,000. Well, now the share price is $2 a piece. You reduce it to $600,000. Now the share price is $4. And you can see eventually here, when all the debt's repaid, it's back to the original share value. But this doesn't even account for the growth of this tax-free company. So hopefully, in TAB, this isn't TAB's numbers, but hopefully if this was TAB's numbers, hopefully this $10 a share would, instead of being the same as the starting price, hopefully this is $13 or $15 by the time this is done.
And just for further clarification on that too, we just have a hypothetical here, but with the way TAB is structured, with any good fortune for us, if we're doing really well, it'll give us a chance so we're not waiting the whole term of the loans that we have, 5 years, 6 years, 7 years, whatever it might be. We have excess cash flow. We can put that towards paying off the loan faster, which only provides all the benefits of making the company having more equity and having more value faster, which will only benefit us in the long run.
Exactly. I mentioned the impact on value. I talked about being smart about it, not just save every penny at the expense of the work product. So I'm not going to get too much back into that, but just think about that. Think about what little things maybe you thought about over the years that you never really mentioned, but now you're an employee owner. Now it goes into your pocket. So ways of cutting costs and increasing revenue. So keep your thinking cap on there. Now, you have several advocates as ESOP participants. Kind of the top of the line is the independent trustee, somebody that represents you to the Department of Labor and make sure that all the rules are being followed, nobody's being discriminated upon, we're following the plan document. It gets the stock value every year, hires a valuation plan every year, and by federal law acts exclusively for the best interest of the ESOP and the participants, you. And her name is Kayla Adams. You may or may not meet Kayla, but believe me, she is kind of overseeing, making sure, and her livelihood depends on representing you properly, because she's representing to the Department of Labor. She is. Her name is Kayla Adams, and she's I've known her for a long time. She's going to do a great job for you. There's also an ESOP administrative committee. And this, I'm going to leave this to Tony a little bit, but these folks are kind of like the go-to for most of the employees. Just want to learn about the plan, have some basic questions. They make some decisions about how the employees are going to get paid out on a non-discriminatory way. They make some decisions on plan design. Maybe something's not going the way it should go, and was an oversight. They can talk about that and maybe recommend and some amendments or some changes to the plan if need be for the benefit of the whole. And then also, the ESOP Administrative Committee are Tony, TJ, and Debbie. So go to, ask questions. They're your advocates as the official ESOP Administrative Committee. And I love this concept, but I'm going to let Tony discuss this.
All right, let me talk about this group for a minute, and then I'll tie back all three, because as Dan mentioned, there's three different levels of advocates for the company. Along the way, we have the administrative committee of Debbie, myself, and TJ in terms of overseeing this third-party group. You've heard me mention in prior emails, Blue Ridge Associates. They are really doing the meat and potatoes of the work for the plan. That's what they do for a living. They're an ESOP company. They're all about ESOPs and ESOP administration. So we're an oversight of that group. This group is a little different. This group is made up of a group of employees at TAB, along with myself, who are going to act as ambassadors and representatives for the larger employee base. This group is, and we're going to be meeting towards the end of the month for the first time, is going to start to look towards one of the things we identified at the last all hands meeting. You remember one of the goals I said was an engage, collaborate, and delegate concept, and try to pull together, which I know people have given feedback on, across departments. Try to knock down some silos, try to knock down some, hey, let's find out what you do or don't do throughout the day, because it does impact me, and just get a chance to have working sessions. This is an assignment. It's not a permanent, the committee is permanent, but the membership will rotate. If you can imagine like a city or town having a council or a group of officials that every so often, a few names change hands, others do the same. Because if we turned over the committee every year or every 2 years, we'd have to reinvent the wheel every time. This group represents all departments. Every department is represented, and it represents a cross section of people who've been here for a while, and some people who are newer to the company to get different perspectives. And then I sit as the management representative on the company. However, there'll be opportunities to work with the entire management team as well. And this is a very, very open-ended committee with a lot of places we could go. Some of it will be ESOP related. Some of it will be workplace related, as we try to enhance and reframe TAB's culture into a true stakeholder culture and a culture of accountability. So that's what the plan is for this group. So then let me briefly bring back all three. So 3 levels of advocates. You have this work group that I mentioned with employees. Then you have the administrative committee, which is really overseeing the third party that's doing the administration of the plan. And then you have Kayla Adams, who is the trustee of the trust that owns the shares. Kayla's not part of the management team. She doesn't work alongside TAB in that capacity. What she's really doing is making sure that we as a company are doing all the right things operationally, so that the trust is remaining a safe and sound entity that can allocate those shares on an annual basis.
Great, I love that. Okay, last thing here, little housekeeping. Beneficiary designation. Sometimes people laugh at this, but, well, not this part, but you'll need to complete a beneficiary designation through ESOP Connection, which is Blue Ridge ESOP Associates website. That's where you can get also the plan document. If you want to read, if you can't sleep and you want to read the ESOP plan document, not if you can't sleep, but if you want to look at that, I encourage you to look at the entire document. There's also what's required by the federal government. It's an excellent idea. It's called a summary plan description, or SPD. You've got one for your 401k. You can read, it's kind of the summary and the highlights of the plan, vesting schedule, all that kind of stuff. That'll be on the ESOP Connection website. And also eventually you'll be able to check your account balance. Now, just to caution you, you go in there and check that. It only changes once a year. So you'll get a statement about every May or June. So if you check it every day, you're going to be disappointed because it only changes once a year. But also on that site, you're going to have the opportunity to complete a beneficiary designation. So if God forbid something would happen to you, you become incapacitated, who gets your plan benefits? And to just people chuckle at this is the part. If you're designating somebody other than your spouse and you are married, the spouse must sign off on that and get it notarized. So for what it's worth. And that is the presentation. I hope that was helpful, and congratulations on being 100% ESOP owned.
Anybody have questions? Questions about the presentation? Questions for Dan about what you saw today? A lot of material to digest. We definitely recognize that. But yeah, Shannon, fire away.
Is there any goal, or do we have any tentative date of when that debt will be paid off? Is it,
It is.
10 years? I mean,
yeah, the goal is 5. The goal right now is 5. We have one loan that's 10, but it's only a small percentage of the rest of what's there. So even if we got most of it, Shannon, paid off in 5, it will really add to the value of the company. Donna, I'm not sure. Donna, I think you had your mute off. Did you have a question as well?
No.
Oh.
I mean, I've been there for a long time, but I know I won't be there, I don't anticipate, I don't know what's going on, but since I moved, I don't know how any of this affects me, but I guess I will find out. That's all.
Yeah, and I understand where you're coming from, because wherever the day was that Tab went to this format, there's always that place where everybody is at a particular point in time. So yeah, appreciate your thoughts on that. Yeah. Lisa, I saw you come up. Did you have a question too?
I do have a question. It's just in regards to management. There was a slide there as far as management is not changing. Are you going to continue to stay on as president and controller?
For the time being. It won't be permanent. It won't be permanent. It's right now what we looked at is the combination of, we're in a place right now where I guess you'd say, workflow wise, that I can retain the responsibilities, but also that coupled with Laura's retirement, we also have to look when we bring in Laura's replacement too, and then see how we might restructure some things.
Gotcha.
There is something I failed to mention earlier, is there's 5 triggers in which an employee receives a payout. It doesn't mean just because they receive a payout with each of those triggers doesn't mean all reasons for leaving are treated equally. Everybody in that category is treated the same. So if you quit, you get paid the same way everybody else that quit got paid out. If you retire, you get paid the same way everybody else that got retired. The point being, if somebody quits or gets fired, the purpose of an ESOP is to not incentivize people to quit or do something to get fired. We don't want people quitting just to get their money, or quitting to start a competing shop down the street. So typically when somebody quits, they may have to wait 4 or 5, 6 years and then get paid in maybe 5 pieces, as opposed to getting all the cash up front, as opposed to somebody that retires, as opposed to somebody that dies or becomes disabled, who them or their family may really need the money. And so just to be clear about that, safeguards are built to protect the plan and the remaining participants from someone just quitting just to get the money. And any talk about debt being repaid, and I know, Tony, you said that was the goal, and that's important. I just want to be clear that that's a goal. There's certain payback that's in writing that we have to do. The goal is to accelerate that, but it's not a guarantee, just for the record.
And that's a fair point, because what'll happen is we can meet the goals, or we can meet what I'd also call the ambitions if you wanted to get ahead of it, but it's also driven by the performance of the company. If we were to have some tough years and not do as well, then we would have to slow things down and only commit to what we had to pay. So there can be influences there too. If 2022 or 2025 wasn't a really great year, we might have to, back off a bit in terms of the, what we can do on the debt piece of it. One other thing I'd like to mention too is just to give you a sense of timetables, because it's a lot to digest, a lot of information. I think it's like anything else we do. If we roll out something new, or when we were first learning how to use ConnectWise or something like that, after a while, when you look back on it, you remember, okay, now I know how to use these things. The timing of the plan, what happens is we have to get up and running with this third party, Blue Ridge Associates. We have to get access to their systems. They have to collect the documents for the plan and start the process of getting that information to a place that we can disseminate it to everybody so that it makes sense. The next part is we have to close the books of tab, which we just did probably yesterday, based on some of the year-end work that Deb and I are doing. We have to take that information, get it to our outside accountants so they can prepare our official financial statements. And then the company has to go through the same or a very similar valuation process as of 12/31, which was a bit surprising to me, because we just did this as of December 7th. We valued the company, we had this transaction there, and because the plan year end is 12/31, by law, we have to do the process again. So, and that would have been whatever date we closed, anytime we would have to do this again. I'm told because only 3 weeks went by, it's not as big a deal, but it just keeps adding to that timetable of when we can prepare everybody. That real question of, well, when do I get that first statement? When do I get it? When do I get a look at it? I think it's only going to be about 4 to 6 weeks for some of the initial documents to be available. But our statements that we're all going to see, it's probably going to be, I'm going to say late spring to early summer, which is typically what happens with ESOPs. And if you know people who are part of pension plans or things like that, sometimes there's quite a bit of lag time. But what I will do is, along the way, I'm going to keep everybody updated on things. Even if a tab everyone goes out and I say, you know what, not much happened the last few weeks, at least you'll know that, we're still progressing. So this is only the beginning of providing a lot of, a toolbox for people, resources, communication, and things like that. I just wanted to give you, kind of set the expectations for you as we go forward. But I didn't want to take away from more questions too, if you have them though. All good? Okay. Well, listen, thanks for setting aside a few minutes. Really appreciate it. If you think of things along the way, just reach out. This deck will circulate to everybody, like what we've done for the all hands meeting as well. So you'll have this to refer back to if you just want to, leaf through it at some point at your leisure. But
Nice seeing you all.
Thank you.
Great
Thank you.
day.
Thank you.
thank you very much.
Bye.
Bye. And we'll exit out here. Just stop the share. And we'll sign out.